Most people think $100 is too small to make a difference. But what if I told you that investing just $100 every month in the S&P 500 could grow into hundreds of thousands of dollars over 20 to 30 years? Stick with me, because I'll break it down step by step, show the math, explain the strategy, and reveal why starting early is more powerful than making the perfect stock pick. This video is 100% educational, so remember to always do your own research. Investing doesn't have to be complicated or scary. The S&P 500 is a collection of the 500 largest U.S. companies, which includes giants like Apple, Microsoft, and Amazon. Historically, it has returned about 10% annually on average. By investing $100 every month, you are taking advantage of compound growth, which is one of the most powerful forces in finance. Why $100 per month is enough? A lot of people underestimate small investments. $100 seems tiny, but consistency beats size. For example, if you invest $100 every month for 30 years at an average 10% return, your investment could grow to over $300,000. That's the magic of compounding. Your money earns money, and then that money earns more. How to start? Step 1. Open a brokerage account that allows monthly contributions. Step 2. Select a low-cost S&P 500 index fund like Vanguard 500 ETF, VOO, or SPDR S&P 500, SPY. Step 3. Set up automatic monthly investments so you don't forget. This method ensures discipline and prevents emotional decisions. The power of time. Time is your best friend. Starting at age 20 versus age 30 can make a huge difference. Investing $100 a month for 30 years starting at 20 gives you nearly $100,000 more than starting at 30, assuming the same returns. Even small investments early in life beat large investments later.
Risk and volatility. The stock market fluctuates. Some years you'll see your account drop, maybe 20–30% in a year. But historically, the S&P 500 recovers and grows over time. By investing monthly, you're also using a strategy called dollar cost averaging, buying more shares when prices are low and fewer when prices are high. Let's do the math. $100 per month times 12 months equals $1,200 per year. Invested for 30 years at 10% average annual return, total contributed $36,000. Total value after 30 years, approximately $302,000. Notice how your contributions, $36,000, are just a small part of the final value. The rest comes from compounding.
S&P 500 companies pay dividends. Reinvesting these dividends back into your fund accelerates growth even more. This is like free money helping your investments snowball over time. Diversification matters. Even though the S&P 500 is diversified across 500 companies, some investors like to add bonds, small-cap ETFs, or international funds for extra protection. The key is to avoid putting all your money in one stock, especially when you're just starting. Key takeaways. $100 a month adds up surprisingly fast. Start as early as possible. Time is your best ally. Be consistent. Ignore short-term market noise. Reinvest dividends. Diversify when possible.
Common mistakes. Investing in trendy stocks without research? Trying to time the market? Not starting early? Forgetting to reinvest dividends. Remember, slow and steady wins the race. You have to remember one thing. Consistency greater than timing. $100 per month might not seem like much today, but years from now, it could be life-changing. This video is educational, not financial advice, so always check your own numbers and make informed decisions. If this video helped you understand how to start investing in the S&P 500 with just $100 per month, hit like, subscribe to Truelytics, and turn on notifications. Your future self will thank you.